My name's Wulfekuhle. I'm the past president of the Iowa Pork Producers. I want to welcome everybody today. Our first speaker is Ron Durre. Ron grew up on a grain and hog farm in central Illinois and graduated from the University of Illinois with a degree in ag economics. Over the 25 years of his career, Ron has been involved in virtually every aspect of the industry, including production, genetics, and system management. He has been a longtime member of the Pork Alliance, as well as serving on various NPPC task forces, including feed availability and the Farm Bill. He is also actively engaged in daily pork production, having 2 contract finisher barns. Ron is Regional Vice President of Farm Credit Mid-America, where he leads a team of 13 vice presidents that focus on bringing lending solutions to customers with specialized and complex agricultural needs. From 2007 to 2016, Ron served as Relationship Manager at Farm Credit Services of America, where he served as Vice President of the Swine Industry Commercial Lending. Ron Durre will talk about starting the courageous conversation with your lender going into another tough year. So please, everyone, help me welcome Ron Durre.
All right. Very good. Well, thank you, everybody. It's great to be here today to visit a little bit about the pork industry. As we were preparing for this talk today, you know, there's obviously a very wide and broad spectrum of people in here, different parts of the industry, different needs, et cetera. And so I got thinking to myself, what I'd like to do is actually just pull some random thoughts and some practical thoughts. Again, given my background, I'm almost a producer who likes to who lends a little money here and there. And so what I wanted to do is basically just kind of talk in general about some things that we have going on that we see in the industry and from a lender's perspective. So with that, here's our agenda for today. We're going to give you just a one-page slide, not a big dog and pony show about Mid-America, but I do want to let you know who we are. Secondly, we're going to talk a little bit about general farm financials right now. Okay, what's the economy look like in general as far as farm financials? Then we're going to move into what the U.S. pork industry is and how we see it through our eyes. We're going to talk a little bit about the lending relationship with your bank and what that should look like, some things to think about, some things to look for. And then we're going to talk a little bit about some stress testing. And so that's our agenda for today. So, to talk just a little bit about Mid-America. Mid-America is actually the second largest farm credit association in the farm credit system. We have about $22 billion in assets. And we primarily cover these 4 states, Indiana, Ohio, Kentucky, Tennessee. The group that I lead is our agribusiness group, where we specialize by industry. So what we do is we have a swine specialist, we have a dairy specialist, a poultry specialist, so that we can really focus on bringing customized solutions and being in those industries every day. Okay, so that's what we do. All right, moving on. So one of the questions that we get every day, or just about every day, are we heading into the 80s? Does it look like we're heading into the 80s? Okay? And I think Mark Twain so eloquently put it, history does not repeat itself, but it does rhyme. Okay? So let's take a look and try to answer that question. What do we think? Are we heading back into an 80s kind of a situation? Entering in the 80s, and I know there's some of you in here that were around when we went through this. We had a 7% prime interest rate in 1977, which rose to 11.5 by 78. So we had a 4.5% increase in the prime rate in a year. Okay, and obviously it peaked at about 20% in 81. High general inflation. All right, which we don't have today, but you can see back those 5 years that are listed there, anywhere from 6 to 13.5%. Okay, so that was another thing that's different than what we have today. Incomes from 76 to 79, farm incomes actually averaged about $51.8 billion, which was actually lower than the 1960s for farm income. And then, of course, in 83 we had a big drought and no crop insurance. Okay. Today, what's different? Interest rates are at historic lows, And there's a much greater use of fixed rates than what we've seen in the past, or what we saw back then, right? So today in our portfolio, over 60% of our loans are actually on fixed rates, okay? So that's something else that's very different. There's really no expectation, guys, that the interest rate's going to rise rapidly anytime soon, okay? We think that over the course of the next couple of years, we could rise somewhere between 200 and 400 bips. We think that maybe in the next year or so, we're going to see somewhere between 50 to 75 bip raise on the variable stuff. But that's we don't think it's going to skyrocket, go 4% in 1 year. Okay, but over the next couple of years, we need to be watching it. Strong farm income in recent years, right? We know that. Farm real estate lending caps. One of the things that lenders did differently in the last couple of years, the last 10 years, was we actually put what we call lending caps or sustainable lending levels on a lot of dirt. All right, and so what happened was a lot of lenders would only lend up to a certain maximum per acre. Right, and so what happened was that's very different than what we had back in the 80s. And so it's actually kind of interesting. We kind of talk about it as a lender. We talk about it and say, you know, normally the producer comes in with a down payment and we supply the rest. And over the last 5, 6, 7, 8 years, it's actually been just about the opposite. We're kind of the down payment and they're supplying the rest in cash. So again, very different. And credit's available today. All right, it's actually very available. So those are some of the things that we see. Let's talk a little bit about interest rates. Okay. Wouldn't be a lender if we didn't talk about interest rates a little bit. I think it's really interesting if you take a look at this chart. The 10-year Treasury is the blue line. The bank prime rate is the red line. If you go back here to 1958, the prime rate was 3.25%. Okay? If you go to today, the prime rate is 3.25%. So in the last 59 years, we're at a point right now where we were 59 years ago. Now, what's also interesting is that 90% of the time, this obviously has been much higher than 3.25%, and the last time that we've had interest rates low like this, okay, where it's been a 5-year stretch. That's the longest period in that 10% where we had low rates. We're already into year 5 of those low rates. Okay, again, we've been saying for 5 years, interest rates can only go up. You know, take a look at it and say, yeah, you know, you gotta if you're betting, man, you gotta say, man, the rates are going to go up. So, be thinking about that. Be thinking about your positions. All right, let's move on a little bit to the state of the union in the pork industry as we see it today. So first of all, generally speaking, balance sheets are very healthy. There's very little operating debt, believe it or not, in our industry today. Credit is available. In fact, competition is pretty good right now. Expansion is still underway in a big way. And demand continues to be solid. So that's what we have going for us. That's a good thing. Okay? So let's talk a little bit about the U.S. pork industry today. And most of these things shouldn't come as a surprise to any of you. I think we all know these things, but I want to reiterate them just a little bit. Extremely competitive and technologically advanced. We all know that. Stakes are higher today than they always have been. A lot more volatility. We're in a state of continuous improvement in our industry. Okay, and so everybody's always continuing to get better, driving for more, driving for production. The next point I want to bring up is, you know what, we can't talk about averages anymore. In my opinion, they don't exist. And let me explain what I mean. You know, back in the late 80s, early 90s, we could generally talk, hey, everybody's cost of production is roughly $40, right? Give or take a buck or two. That was probably the standard deviation. It was very small standard deviation at the time. Okay, today that is not the case, and so I really almost every conversation I have, I do not answer the question, what is the average cost of production in our industry today? I say, you know what, it varies, and let me show you an example of this. So this slide right here, and some of you have seen me present this in different ways. But this slide right here is actually a portfolio of producers. Not going to tell you who, where, or how many, okay? But it represents roughly 20 to 30% of the entire U.S. industry, okay? And take a look at these numbers. In 2012, the low of those producers was a loss of $4 a head. The high was $28 a head profit, and the ISU average was a negative 12. Guys, that's a huge spread. That's a $32 spread in a pretty significant portion of the industry, right? And these are top-notch kind of producers. If you go to 2013, the gap widens from a negative 9 to a positive 25. In 2014, look at the range there. $73 variance. Now, we know 14 was a pretty crazy year, right? But at the end of the day, it doesn't matter why necessarily. It's the fact of the matter is this is what happened. 2015, 2016, okay? So a lot of people ask the question, why are we still expanding? All right? We've been through some uncertain times, but think about we were asked to do this presentation probably in October or November, okay? Think where we were at in October or November as far as profitability. And now look at where we're at today. Look how much stuff has changed in just the last couple months, right? But my point to this slide is, if you take the people over here, or down here, pardon me, who have made these kind of dollars and these kind of profits over the last 5 years, they're saying there's no place else that we can deploy capital and make the kind of return that we can make like we can in this business. If you take the ones that are on this top row in this low range, there might be some distress in some of those accounts. And so they're going, they're down here in maybe this bottom third, and then you got a middle range in there that's saying, hey, what adjustments do I need to make and what's my future, right? And so when we talk about averages, we have to be very careful that does not paint the whole picture, right? So I just wanted to make sure that's something that's really near and dear to me right now, especially from a lender's perspective. Be thinking about where's my operation and how do I stack up to my peers, because averages mean very little right now in this industry. So let's start moving, as we've given this our base, right, and we've talked a little bit about the general farm economy, we've talked about the pig business itself and what we've seen over the last 5 years with profitability. Now let's talk a little bit about how we start this conversation with our lenders going into uncertain times, okay? This is something that lenders use when they're deciding whether or not to make loans, okay? It's called the 5 C's of credit, and many of you maybe have already heard of this, maybe others haven't. But this is something that if you can keep this in mind when you're getting ready to approach your lenders, these are things to think about and what they're going to be thinking about. One is character, right? So integrity of the person or the operation, what's the structure of it look like, what's the structure of the company look like, management ability. Okay, that's something that's huge when we think about lending. Capital, obviously solvency, liquidity, overall financial positions, very important. Capacity, what's your profitability, what's your cash flow? Collateral, we need to know the quality and the value, okay? And guys, trust me, bankers do not want to own pig facilities. We just don't, okay? But that's why we have to make sure that we understand what the value of collateral is. And then conditions, structures, terms, those kind of things. So again, 5 C's of credit. Again, something that maybe isn't talked about huge, maybe a lot of you know about it, but it's something to think about, right? So that when you can go in and talk to your lender, you kind of understand what their thought process is. So what does a lender look for when we're getting ready to make loans? In one short word, everything. Right? I mean, how many of you go to your lender and they provide information, they come back, they want more information, they come back, et cetera. So that was a little bit of being a little bit facetious there, but I mean, basically, we want to know the quality of your operation. We want to know everything we can about it. Accurate, complete, and timely financial information. This is something that, believe it or not, in our day and age, is still a struggle in certain places, right? The ones that are good, the ones that are viable management, good companies that are doing well, they know this and they know it often. But it's something that's you got to have. It's an essential. Trends. Is your business moving in the right direction? Is it are you progressing in the right direction? Risk or margin management plans, right? Honestly, sometimes we don't care what kind of a plan you have. You just need to have one and then execute it, okay? As long as we know what that is, that's the important part, and then that you execute it. Some people's risk management plans or margin management plans are to ride the market. Fewer and fewer every day, but some still have that strategy. If you got liquidity and big enough balance sheet, you can do that. So. Cost of production, guys. Some things never change, right? You got to be a least cost producer in this industry to continue to be competitive. Communicate early and often with your lender. Okay. We can do a lot of things early on. If we know about situations early on, make sure that you're communicating with us, letting us know if you're going to feel some distress or whatever. Let us know those things ahead of time, because the earlier we know, the quicker that we can make adjustments and the more options we have available. Liquidity, keep it flowing, right? We want to keep liquidity flowing. Openness, honesty, and transparency, I think that's kind of a given. And adaptability. What's your willingness and ability to adapt to change? What should you look for in a lender? Right? I would say a lender that's knowledgeable about your industry, and this is becoming more and more crucial. There's a very small fraternity of us who actually live and breathe this industry every day, and it's going to continue to be even more important as we go forward. You need to be able to have a lender who understands the cycles, who understands what PED is, who understands what PERS is, and how it disrupts flows. So you need to really search out for a lender who understands your industry or this industry. Proven track record for staying committed during the downturns. Guys, there's a lot of lenders out there today who are in and out, right? When it's good, they're in. When it's out, they're bad. You don't want that. With the capital intensity in our business today, you can't afford to do that or to have that. Relationship's important, not just money, and especially not just cheap money. We need to make sure that we're building a relationship with the lender so that we can continue to plan and continue to come up with creative ideas or solutions that you need. And capacity and willingness to grow with you. And again, with the kind of amount of capacity the amount of capital that our industry takes today, it takes them a large amount of capacity on the part of your lenders. So let's talk a little bit about some stress testing. And I would hope that a lot of you do this. Maybe some do, maybe some don't. What you need to do is actually put together pro forma balance sheets, right? So do a couple different scenarios. Develop a best case, a worst case, and a likely case. And then keep reevaluating those. Reevaluate them. Some people do them monthly, some quarterly, some yearly. But make sure that you're doing that so that you can understand what kind of staying power you have. Then determine your ability to withstand the down cycle, right? Obviously, there's a whole lot of covenants and there's a whole lot of measurements that go into our swine operations today. But the three key ones that you can begin with are owner equity, liquidity, and debt coverage ratio. And as you take a look at those, you ask yourself, okay, what happens in my best case? What happens in my worst case to my primary covenants or to my primary ratios? So, I think besides the financial side of things, I think another thing that's important is we also have to ask questions about the overall structure of our business, right? And what our plans are. So what's your role in the pork industry in the next 5, 10, 15 years, right? Ask yourself if your operations prepared and willing to survive in the coming industry. I personally believe we're going to see probably more changes in the next 10 years than we've seen in the last 20, maybe the last 30. And we've seen a lot of changes. So I would say, ask yourself if you're ready and willing to do that. What's your succession plan? Okay, do you have heirs coming back? Do you have a management team in place? Are you planning on growing, or are you planning on exiting? And then what's your risk-reward tolerance? Because with the more volatility that we have today, the risk-reward tolerance is going to get higher. And so I would just, again, ask yourself some of these questions, figure out where you want to go with your business. So some of the takeaways from today, Remember the things that a lender's looking for: financial information, trends, cost of production. Make sure you communicate, keep lots of liquidity, open and honesty and adaptability. Make sure you choose a lender that understands your business, right? And I can't emphasize that enough because that is real key. Stress test your operation. Do some projections. Ask yourself the questions about your role in the future, right? And it's okay if you say, I'm not sure I want to be a part of this going forward. But you need to be honest with yourself so that you can take a look and say, okay, what's my exit strategy? What am I going to have when I'm done, et cetera. And I would definitely consider fixing your rates right now. Again, you saw the chart. Historical lows, we're in that 5-year period right now. I don't think there's anywhere to go but up, and eventually we'll be right in saying that. So conclusion. Believe the long-term future of the pork industry is bright. I have a strong passion and belief that that is true because our U.S. and North American industry still has the infrastructure, we have the feedstuffs, the technology, we have the management ability. I think this is still where we're going to be able to raise pork the most cost competitive on a global basis. I really do believe that. Capital is available for well-managed, profitable operations, right? So, again, it's available today. And we're going to continue to see headwinds and challenges. But I think that this industry will continue to offer solid returns for those willing to compete. So with that, I just want to say thank you. Again, just some broad overview, general comments. I'm a big Q&A guy, so I'm anxious to see if we're going to save questions for the end, right, Al? Yes. Okay. So, all right. Thank you very much.
Thank you, Ron. Our next presenter for this morning is Pat von Tersch. Pat was born and raised on a small family grain and livestock farm near Denison, Iowa. He had attended Iowa State University and received a Bachelor of Science degree in agricultural business. Pat joined Cargill as a management trainee in 1991, immediately after graduation. He held various management and merchandising positions for Cargill for 10 years. In 2001, Pat resigned from Cargill to pursue his passion, working for grain and livestock producers by helping them manage their price risk. Pat started a branch office for Advanced Trading Incorporated and worked with area grain and livestock producers on risk management, alternatives for their operations. In January 2006, he started his own business called Professional Ag Marketing, with the same goals of assisting producers with risk management. Today, Professional Ag Marketing, located in Laverne, Minnesota, is a firm consisting of 5 risk managers sharing the same passion of being our clients' partner and resource for good marketing decisions. Pat will talk about some risk management strategies to protect your margins, as well as some talking points to take with you into the negotiating room with your packer. Please welcome Pat von Tersch.
Thank you very much, Al. I appreciate the introduction here. I might hop down here because it's better for me to move around a little bit. But thank you, everyone. I do appreciate the opportunity today to visit with you. We, and again, appreciate the introduction here. And just to jump right into it, I will give just a little bit more of an introduction here with ProAg, and then talk about some risk management guiding principles that we think are effective long term, and not just in downturns of the cycle here, but and then also spend a little time talking about the producer-packer relationship, and then get into some details on 2017 strategy and try to summarize things up here. So with that, I think, again, I just wanted to reference Professional Ag Marketing, and Mike Fitzgerald is in the room with us today. He's our branch office with us here in just east of Cedar Rapids, and appreciate him joining our team just a little over a year or so ago. So in terms of guiding principles or risk management, so first of all, I just want to spend a little bit of time on why we manage risk in the first place. And Ron did a good job this morning here of talking through the importance of liquidity and cash flow. And I'm going to try to drive into that a little bit further and just talk about managing the zig and zag of the hog cycle and being able to walk when others are running and vice versa. So we'll talk through that a little bit, and also want to discuss, just what our risk tolerance is, and that can be a personal perspective, that can be a financial perspective, and it's certainly many days are both, and then some keys to success and how we do these things. And then the last part is just a little bit of the history of crush, and I would argue that we're evolving here a little bit and sort of changing the way that we look at things, and I'd like to have a discussion about the way that we manage margins today and how we're going to look at that in the future. So first of all, just managing cash flow, obvious benefit of a more comfortable relationship with your creditor. And again, creates the opportunity for you to run when everybody else is walking. And also need to protect ourselves from the black swan event. I've been a little more nervous about black swan events the last week or so than normal, and many of us can understand why, with more volatility concern as it relates to export trade with commodities with the new administration here. And I'd love to have that conversation here a little bit later in the presentation as well. So. First of all, don't have a risk management plan based upon predicting price. A lot of us that have the opportunity to spend a lot of time looking at these markets and talk to folks about it. We had supper last night with some of the folks in our industry, if you will, and there's an awful lot of opinions flying around. But at the end of the day, we don't know, right? We don't know what the market's going to do. We don't know whether or not it's going to start raining again in the southern part of Argentina, or whether or not it's going to stop raining in the eastern part of Argentina. We don't know what the weather's going to do next summer. We don't know, for sure what's going to happen with exports on hogs and things like that. So if you got a risk management plan based upon bias, at some point it's likely to fail for you. So we work really hard with our clients in developing a plan that makes sense for your business, defining cost of production, and then executing that plan based upon appropriate returns. And then the next point is just having a contingency plan. It's good to have targets in place, but what if we don't have the opportunity to execute? We need to have a contingency plan. A good example of that is last summer. We had a nice little rally in December hogs in that June time frame. Never really hit a targeted margin, but we kind of had a self-imposed goal in our shop, at least, that we were going to make sure that we were executed by the 1st of July, and we're happy we ended up executing that for Q4 last year. And then also just managing that secondary opportunity cost. If you got a lot of equity in positions, it may make some sense to switch to a more option-based strategy and just continue to look at your position and make sure that you're maximizing the opportunity. The next point here, I think, is pretty important, and I've for the last 15 years or so, I've been working directly with producers on risk management, and 10 years prior to that with Cargill, and I've seen all ends of the spectrum, if you will. Where I start working with a client, and the client will say, "Pat, I don't want to have anything to do with this risk management stuff. Don't bother me with it. Just take care of it. I've got other things to do. Let me know how it turns out at the end of the year," right? And then the other end of the spectrum, "Pat, I got this whole thing figured out. Don't call me. I'll call you when I want to do something, and I got this," right? And so two opposite ends of the spectrum in terms of interaction. And I'll tell you that through the years, what I've learned is that somewhere in the middle is right? I mean, it's vitally important that you find someone that has the same type of approach, philosophy that you do, but that interaction, that give or take on a weekly basis to talk through what's going on and make those decisions together and have the backdrop of what your expected goals and plans are, is how we make the best decisions. And we don't suggest that we have the corner on that market, if you will. We think we do a pretty good job, but the importance is, for all of it, that you find someone that you have a comfortable relationship with, and there certainly is a huge opportunity there in terms of creating less emotion and unbiased when you're working with someone outside of your operation. And then the next point here is just, create a mechanism to keep all individuals involved in the operation who have a financial interest. So, a lot of our organizations today are multi-generational. A lot of our organizations today have multiple owners. And, typically there's one or two people that are primarily involved in the decision-making process as it relates to risk management. Make sure you have some type of a procedure, policy, process in place internally that you're communicating the decisions that are being made early and often in terms of what the objectives are and what the execution strategy is. It's a lot easier to talk about those things internally while they're occurring versus after the fact, similar to the lender relationship. So. And again, establish those goals from the outset in terms of what you want to accomplish, and make those goals based upon, return on investment. My goal is to increase my net worth every year by X percentage, whatever that backdrop might be. But make sure that's been discussed, written down, established, and everyone's on the same page. Next point, 2 steps to the process. The first thing is deciding what we're going to do. Figure out what you're going to do based upon targeted margin, all-in cost, what % you'd like to market at those levels. And then the next decision is how we're going to go about doing that. And there's a material difference between, once we've decided that we're going to hedge some pigs, material difference between being short in the futures market versus a forward contract, and maybe we're locking in basis directly with the packer and that sort of a thing. But just keep in mind that it's important to separate those two decision-making processes and then execute what makes the most sense for your business. And then the last point there, managing basis is a critical component of this plan, right? Everybody can make a spreadsheet and project what margin's going to be, but if we don't do a good job of managing the cash market, the cash basis portion of the thing, it can throw a wrench into things pretty quickly. Another observation here, just as it relates to the how, right? Once we've decided to make some decisions as it relates to risk management, there's a big difference between selling futures and buying puts, as an example, in terms of the margin that you're defending and the reward opportunity to capture. So just think through on the spectrum here of the most bullish selling or most bearish selling hog futures versus doing nothing on the other end of the spectrum, and make sure you're applying the right strategy to what you're attempting to accomplish. So a little bit of history here again on hog margin risk. When I started doing this in 2001, we thought that we had this grandiose idea that we were going to use a 100% based option sort of strategy and, protect the downside on hogs, protect the upside on corn and meal, and just let things kind of play itself out from there. And quickly discovered that isn't going to work. There's not enough margin in this business to be paying premiums on options and accept the slippage associated with it. So, largely went to a decoupled input, locking up inputs and selling pigs, not necessarily doing that at the same time from 2001 through 2006. And then coupled that strategy, as commodity markets started to work higher in 2007 and 2008. And so, the industry has become pretty comfortable, I think, with this crush concept since that point. And I would just argue that we're, the last couple years coming off the PED era that has changed, and we're starting to look at a little bit more of a decoupled strategy. And I'd like to spend a little bit of time on that. So this is just an illustration of kind of prior to 2008, and this horizontal line here is a $16 per head targeted margin. And you can see, prior to 2008 or so there. Not many opportunities from a crush perspective, buying corn, buying meal, and selling pigs on the same day. And then really from 2008 forward, we had a lot of opportunities to extend the crush, and then with the kind of the culmination there in 2014. But again, we just reference the time frame since then, the last couple, 3 years here. We just really haven't had many opportunities all in terms of locking up that crush kind of same day, if you will. And I think, one of the reference points to this thing here, and I just pulled up this historical corn chart too, and it goes back to 1984, a monthly chart. And I would just say that just in terms of an observation going forward here, in terms of a little less volatility. So prior to the ethanol expansion era, we spent a lot of time with corn futures in that, $2 range, right? For, all the way from 1998 through 2006. And then as we expanded corn demand and also had some weather events associated with that and some outside influence, but tremendous amount of volatility in all commodities. Again, this is the corn chart in particular. But again, would argue that kind of coming off of that, as we've taken corn used for ethanol production from zero, basically, in the year 2000 to 5 billion bushels in 2010, now we're starting to settle back into a little bit of a range again. And I would just argue that 350, 375 corn futures is kind of the new two, if you will. I think that's the we're starting to see a little more stabilization. Back in the day, for my row crop producers, if you hedged corn at 275 futures on a weather scare in June or July, right, in that 95 to 2004 time frame, that was most of the time a really good decision. And the last couple of 3 years, same thing for row crop producers. Instead of at 275, it's 435 now, right? But it's been a really good decision. So, and I think from an end user perspective, I think that's important. And it gives me confidence, at least, to sort of start to think about, at some level being able to decouple that crush sort of concept and make sure that we're getting long inputs to further define our cost of production at bottom end of historic range. So just to put that in perspective, we've spent less than 10% of our time in the last 6 years with nearby corn futures below 359. Okay, so we've had a couple of record years of crop production, which certainly has helped things there. But we just really haven't spent a whole lot of time sub 350 futures. So this is the traditional crush model that was printed a few days ago. A little bit better opportunity today with yesterday's market rally. But again, just we've got hogs that have worked quite a bit higher, nicely higher from when we decided to have this meeting in October. But corn and soybean meal in particular have gone with it and seeing the same thing again, right? Nice hog rally, but the crush, right, is essentially break even at this point as a result of the input rally. So our approach today in terms of managing hog risk, again, would argue that volatility is lower. There's a little less opportunities for crushing pigs. And we'd like to look at opportunities to buy grain feed options in the winter to protect ourselves against potential weather problems, and then look for the seasonality of harvest time frame to get long inputs here. And then in the last point, we also would look for opportunities as they present themselves to be aggressive on the revenue side when that opportunity presents itself. And times you may need to look at a Dees forward sort of a spread concept in order to gain additional coverage when that opportunity presents itself. So this is an example of a drought coverage hedge that we would utilize during the winter months. This is buying a December 17 $4 call and selling a 350 put. So I just mentioned that, we spent less than 10% of our time below 350 futures, right? So what I'm trying to do here is fund the expense, if you will, of that $4 call option. All I'm doing is protecting myself against this year being the year that it doesn't rain, right? And I'll use that 350 put to fund that position. When this was printed the other day, it was at the cost of that strategy was 19 cents. We've extended some coverage here, since harvest time, a couple different times under that 10-cent area. So, the idea here, guys, again, is not to necessarily defend or get long corn at 392 or December corn is trading at today, but just protect ourselves against a weather problem materializing that's able to sustain itself, right? And chances are, I would argue, at least the last few years, it's worked pretty well to be able to buy back that 350 put on a weather rally, which would then reopen the downside for us and allow for us to participate in the full value of the move. If the move lower, if it presents itself in a normal to big crop year. Does that make sense? All right, so let me just switch gears here for a second and talk about a little bit state of the industry and independent producer and packer relationship. And we got a few packers in the room, which I appreciate, and we're going to talk a little bit about the current challenges associated with the margin structure today. But more importantly, I'd like to talk about the kind of the intermediate opportunity here as we kind of transition with some packing capacity space being added, and then talk about the long-term relationship and the threat of vertical integration. So this is what I'm referring to. I tell you, this is doggone impressive. The green line here is cut out. We've been able to sustain meat values at some pretty doggone good levels here over the last 3 or 4 months, in spite of record slaughter, in spite of record production, and recently here this week we just had another friendly cold storage report, and we're seeing pork stocks reduce month over month as well as year over year. So demand disappearance is very good, and the challenge here from a pork producer's perspective is the relationship between the cash and the cutout markets here, and this gives you a little bit of a feel on how that's looked the last 3 or 4 or 5 years, and so. Even during the PED year, so this is just measuring the difference between the Western Corn Belt cash and carcass cutout values. You can see the trend, right, folks? We've been widening that gap, for the last 4 years here. The kind of the crest, if you will, there in October. And November, and we've seen a fairly significant drop in that margin structure here over the last couple of 3 weeks from a packer perspective, but still relatively wide from what we've seen the last 4 or 5 years. And this is the graph that is driving packing plant capacity construction. We expect that to go up about 7.5%. Next fall versus last fall. So there's change on the horizon. The economics of the marketplace still work, and I think from a producer's perspective that we need to use this opportunity, fairly unique, to have 2 large-scale plants under construction today with the capability of double shifting in the not too distant future, and additionally a third plant in north central Iowa. So use this opportunity to drive value into the working relationship with your packers. I encourage you to open communication up with packers outside of the usual working relationship. We've got to try to figure out a way to make this independent producer, independent packer model work in the long term, and I think we've got to start to think about it just a little bit differently than negotiating 2-year deals at a time. So not suggesting that we need to give notice on all of our agreements today, but start to build a relationship with the packer that you choose to work with. And the goal would be is to, when they call in the future with an idea to drive more value through the pork chain, that we're able to replicate what the vertical integrator is able to do. Ractopamine use is a good example of that, right? The Smithfield network was able to capture that opportunity relatively quickly, and I would argue, the rest of us, we got through it, but it was a little bit of a challenge to do that. And I think that's a good example or illustration of what we're talking about here. So, do have some concerns about this industry continuing to vertically integrate and look a little bit more like the poultry model. The independent producer packer model is very competitive. You guys are the best in the planet in terms of raising pigs, and the packers are the best in the planet in terms of processing the things. And so the value is there. The whole chain is competitive. But we just got to figure out a better way to accommodate the changing needs of the ultimate consumer. And the challenge, obviously, here is value transfer. And so how can we mimic that vertical integrator? Can it look more of a dynamic pricing relationship instead of a transactional formula relationship? Can it be a quarterly meeting to talk through what's working and what isn't working, and look at the current economics of the industry and make adjustments that are appropriate? Obviously, anything like a dynamic pricing relationship like that is going to take trust and relationship to make it work. And then the last point I'll just make here is this one: defend the cash market. Folks, we're down to less than 4% of the trade in the cash market today. All of our formulas are derived by this. We're at over 12% in 2006. And it's absolutely essential that you start to take a portion of your production and get them negotiated in the cash market. Mike and I do that for quite a few of our clients, and we've got quite a few of our clients that are doing it on their own as well. So certainly there's resources out there to help you get started on that process, but we've got to. In order to define that transfer value, we've got to raise that negotiated market up. I would just mention that the cattle industry is faced with the same issues, and they've recently started a fed cattle exchange. It's an online exchange that comes out on Wednesday mornings, and it's not a tremendous amount of volume at this point. I think it's 5,400 head or something like that traded last week, but it's getting a lot of market chatter. I mean, a lot of folks. I mean, it's a neat way to for a lot of different folks to be able to define market, and I think that's helping with the liquidity transparency of those trades. So need to continue to look for alternatives to make that process better, in my opinion. But we also have to put the boots on and get it done too. So would just again encourage you to consider that. All right, so 2017. Mentioned earlier a little bit of an evolution in terms of how we look at things, and this is kind of our, I guess, specific sheet, if you will, of what we've been using the last 6 months or so, and we'll just note a couple different things. And so, in addition to defining cost of production as it relates to all the other stuff, yardage rates, other feed, isoine costs, that sort of a thing. And so this little sheet is meant to capture the opportunity on inventory from weaned to finish, right? So all of the other expenses involved with production should be embedded in the fixed cost per head. So again, let me just say it this way: in terms of determining cost of production, what we're saying is it takes $90 per head plus 364 pounds of corn, 136 pounds of meal, 50 pounds of DDGs to take that pig from wean to market. Okay, and so that's how we've chosen to sort of define cost of production. And so this particular sheet would suggest, again, we were wanting to be fairly aggressive, kind of harvest time forward in terms of extending that long on the two most major inputs that at the time were not defined. And so if we're going to have a successful risk management plan going forward here, the more stuff we know, the better off we are, I would argue. So what we essentially did here is back into what would amount to a $9.80 per head margin for calendar year 2017. And how we backed into that was, again, defining cost of production with corn and meal prices at $3.47 and $2.90, and the other all-in is about $67. And then backed into some revenue targets for the months that have not yet been executed that allow for us to achieve that goal. And you'll see that, actually April traded over $70 this week, so we got a little bit more coverage there today. And the market traded within $1 or so of our targets for the summer months here last week, and traded up to 78.65 again today. So that's the plan. That's the plan that we think makes sense from the standpoint of an acceptable return for our producers in this environment, right? And so, saying earlier about the guiding principles of risk management, have a plan that's based upon what makes sense for your business, and this is kind of the nuts and bolts of how we think we get there. And then we need to have a bit of a contingency plan in the event that our targets aren't reached. So we've said that, and have said it for quite a few months here, that if we don't get these opportunities by the middle of February, then we're going to want to start to force the issue a little bit and start to extend some coverage. So that's our contingency plan. Makes sense. We've got a goal in place that makes sense for our business, and if we're unable to achieve that, then we're going to have to use the seasonality or timing to start to execute some trades. Okay, so no question that the industry is expanding, there's a lot of expansion wrapped around packing plant construction. There's a lot of expansion wrapped around a good access to capital situation, as Ron referred to earlier. And so it's crucial to manage our margin structure during times of market appreciation. And we've seen a tremendous jump here in the market over the last 3 or 4 months, and we need to take advantage of that. And then again, knowing your cost of production, having inputs defined helps us an awful lot in terms of making that decision. And so, last point, execute on revenue targets that make sense for your business, but have a contingency plan. And we've got an internal self-stated goal of mid-Feb is when we're going to start to force coverage here. So, Just to kind of summarize here, it's a huge opportunity. We need to manage the short-term and long-term risk and take advantage of that volatility. And I've been having a little bit of fun with this the last couple of weeks here, but we've really seen part of the reason why we've seen a nice little push in this market here over the last couple of months is because of the new administration, right? And we're for the first time, I would argue, since 2008, we're starting to see some decent flow of outside money into commodities as a little bit of inflation hedge. And so, the stock market for the first time traded over 20,000 yesterday. There's a lot more optimism in the outside markets than what we've seen in quite some time, and that's the results of in part because of Trump's pro-growth strategy and infrastructure spending and whatnot. So we're getting a Trump bump, right? But we have the risk of a Trump dump here, right? And there's I don't know about the rest of you, but when I listened to the inauguration speech over the weekend, and then the first thing he did, I think Monday morning, was sign his little executive order to get out of TPP, which was never going to happen in the first place, right? That's not new news, but he didn't mess around, right? He was out of it, and then the next day, I think the wall might be half built by now or something. It's moving at a pretty breakneck pace here. And then I heard last night that the president of Mexico was scheduled to meet with President Trump next Tuesday, January 31st, and he's reconsidering whether or not he's going to make the trip. So, there's going to be an awful lot of volatility with this stuff, and one of these days, right? We're going to be saying, we're going to have some lower commodity markets because we're worried about some trade challenges. And so, again, I would just suggest to you that it's going to add an element of opportunity for us, but it's also going to add an element of risk that needs to be accounted for. Just a couple things just to wrap up here, and I would just say, Dr. Meyer had did a good job yesterday afternoon of explaining all the fundamentals here. But so this is just a little bit more big picture observation, if you will. But we really haven't been able to do much with exports since PED, right? I mean, we've really struggled in terms of maintaining the trend that we enjoyed, clear back to 2003, 2004 in terms of pork exports here. And again, recently we've seen a nice little uptick. But my only point is, in addition to what everybody else talks about as it relates to such things, is that there's some room for growth there. And there's going to be 9 billion people on this planet by the year 2050. And this is still the best place on the planet to grow pork. And so, we need to manage the short-term risks, utilize those opportunities, but long-term, the future certainly is bright. So, with that, I think that's all I had, Hal.
Let's give Pat a round of applause. All right, my role here is a moderator, but also I have a few slides I want to give. I'll give you a little biography of myself. I started farming in 1979. I grew up on a small hog farm in Delaware County. I got married on Saturday. I took a very short honeymoon to Chicago. Moved on Tuesday to the farm that I rented that was 32 miles away from my dad's farm. And I started farrowing pigs on Friday. So I had them all bred and ready to go. So married on Saturday, moved the farm on Tuesday, farrowed pigs on Friday. I think that's pretty efficient. My wife, who's sitting over there, would say that's just plain stupid. So we started not in a good time to be getting into agriculture. We bought our farm in 1980, paid like $2,400 an acre for it, and by the mid-'80s it was worth half of what I paid for it. And Ron can probably tell you when your net worth is zero or below, it's pretty hard to borrow any money. So there's a lot of people my age that really didn't survive the 1980s. Yep. And so the way I expanded is I rented hog lots and cattle sheds and drove a 40-20 up and down the road with a mixer, and that's how I grew my hog operation. And we slowly grew it and got through the 80s. In 1997, an old veterinarian, Dr. Bowden, came to me, and he was overseeing a sow farm. And he said, Al, you want to help me manage this thing because I don't know how to breed a sow. And so I was running my own hog farm, and I decided to do that, and that turned into a contract management business. So at one time I was managing 6 other sow farms besides running our home farm. And that led into 2000, actually 1999, I started negotiating with one of the farms I was managing, said, "You want to just buy this farm?" And so I asked some of my friends in the industry if they'd go in with me, and we started a company called New Horizons Pork, and we grew that farm to about 4,000 sows, 100,000 pigs a year, farrow to finish. When I got out of that, I sold my share a couple years ago, trying to slow down and de-stress a little bit. And that farm continues to grow today, a very, very efficient farm. And so now today, I'm at 1,600 sows farrow to finish, and it's kind of our family farm operation. We run about 500 acres. We still run the records bureau that we started when we were contract managing farms. We do a Meta Farms record bureau, so we do records for 5 sow farms and about 200,000 pigs a year, finish records. So that's a little bit of my background. Help me out. So what I want to talk about is managing margins in market downturns. And I want to thank CIH. There's a couple of guys sitting right here. Kurt's one of them. Helped me put these slides together, so thank you for doing that. So the way I look at it, and it started way back when the first group of hogs that I raised, 1979, I forward contracted them to Oscar Mayer in the fall. And Oscar Mayer is no longer around. I think Tyson bought him years ago. And I made money contracting them. The price went down, and I made some money on them, and so I was kind of hooked. And so that's where my career as far as trying to manage margin started. And when I moved to that farm, there was an older pork producer, Leonard Monahan was his name, and he told me, "Al, the key to the hog business and making money in the hog business is you've got to have hogs when prices are good." And I've always had that stuck in my head, that I got to have hogs there when prices are good, because we have some crazy cycles in the hog business, and so you want to enjoy the high prices. So the flip side of that is obviously how to avoid the low prices. So this is one of our sow farms in our feed mill, and this is kind of where it all starts, where we try to decide whether to price our corn or price our bean meal or price our pigs ahead. We're a little unique. We raise about 1/4 of our corn, but we buy 3/4 of it from a large grain producer in the area, and we've been doing this for 20 years, so it's been a good relationship. So then the question is, when do you lock in prices? When do you lock in corn, bean meal, or sell your hogs ahead? Try to evaluate where you're at, where the market's at. Is there expansion or contraction going on within the industry? And then put a plan together. And then execute the plan, because emotions get in the way. And anybody that's had positions on, you've lost money and you feel horrible, and then you make money, and then you start feeling pretty good about yourself. And I have a broker, Ken Reese, he told me once that once you start feeling good about yourself in the markets hit you on the side of the head with a 2x4 and let you know that you don't know anything. So you kind of keep that in mind, that nobody knows, and I think Ron said and Pat said nobody knows which way the market's going, but we do our best to try to work with the averages and here's an example. This is the April hog chart. Futures come on the board about 16 months ahead of when the hogs are marketed. So this April hog chart, you had the opportunity to lock in $72 in June of last summer, and you had the opportunity to lock in $56 in October. So when somebody said, well, you should lock in April pigs, they didn't tell you when to lock them in, and they didn't tell you what level to lock them in. So you could have locked them in at 72 or 56, which is only about a $35 a pig difference in price. So it's difficult. So that's the point. And we talk about market volatility. Volatility is actually a good thing, because it allows you at times to lock them in higher than the market ends up. I think one of these guys talked about black swan events. It seems like the longer I'm in this industry, the more of these that we have. And so it comes back to, if I can just avoid the crashes in the market, and if I can take advantage of the high prices, I think I'm doing pretty darn good. So if you look at this one, 1998, we had a packer capacity problem, and we were really worried about that happening again this fall and winter too. But in 98, they couldn't get them processed fast enough, so they just kept getting heavier and heavier and backing up. And anybody that lived through that and hog prices got down to about 10 cents, it was an awful time. So if I could have avoided that one, that would have been a huge win. The Atkins diet in the mid-2000s, that was a good period for producer margins. We made pretty good money in the mid-2000s. And we had this Atkins diet. We had the media that was all about protein's good for you, and more protein in the diet is good for you. So that made some good producer margins. And so we went from that to, in 2009, which in our operation was just as bad as 1998, we had this H1N1 flu virus. It was a foreign animal disease. It was the first time it showed up in the United States. And it crashed the market. The media decided they weren't going to call it H1N1. They were going to call it swine flu. And so then you had consumers thinking, boy, if I eat pork, will I get the flu? And the market crashed. And so that would be what I would call a black swan event that nobody can predict. I don't care how good you are at marketing, nobody knows when something like that's going to hit. And then as these guys are talking about, we had the ethanol craze or growth or expansion, whatever you want to call it, started about 2006. And the challenge with that is it took about 2 years to build an ethanol plant, and they build them for about 2 years too long. So we had that, and then we had a 2012 drought, so we had a short crop on top of all this demand from ethanol, and so that was a really tough time. So we went from that in 2012 into 13, and then 14, boom. Producers were holding back. They weren't expanding. It was a tough time. And PED hit, another foreign animal disease. But this one, not like swine flu, this one wasn't a disease that stopped exports. So all of a sudden we had 5 to 7% less pork. Demand was still there, and we had the highest prices that we've ever had in my career in hog production. And in our operation in 2014, we made more money in 1 year than we did in the previous 10 years combined. So it's back to my old mentor, Leonard Monahan. If you can enjoy and have hogs to sell in a year like that, that's the key to surviving in this business and buying tractors and hog buildings and buying land. If you can enjoy those times and avoid the really bad times. So here we are with expansion. This industry is growing. We had another packer capacity problem. This is just a chart I threw in there, and this is already discussed. When I was born in 1959, we had about 3 billion people on this planet. Today we have 7.5 billion. By the time my grandkids grow up, I suppose we'll have 9 billion, I think is what they're predicting. So we are feeding more and more of the world. We didn't become a net exporter of pork in the United States until the early 90s, and now we are exporting close to 25% of it. So most of the growth in the U.S. pork production has gone to exports in the last 20 years. This is just an export chart, and this goes back from 2000. And I just wanted to throw that in because if you look at the population trend and the export trend, kind of the same trend. So this chart goes back. The blue line's a 5-year average. The green is the 2016 hog production. Red is 2015. Where the circle is in November, December of 2015 and 16. In 2015, we had a packer capacity issue, and the industry was telling us that we were running over packer capacity 4 or 5 weeks maybe, and the packers in the audience can probably tell me exactly what that was. So then, some of us in the industry was thinking, we're still expanding. We have no more packer capacity, and what's going to happen to the markets in 16 when we exceeded capacity in 15? So we were really concerned about it. And actually, our friends in the packing industry did figure out a way to process all these pigs. And you can say, yes, they made really high margins on it, but in any business, the law of business is expansion follows profitability, and we wouldn't have these new packing plants coming online if the packing industry wasn't really profitable. So I guess we can thank them for growing, but we would have liked if they would have shared a little bit more of their margin with us in the last 6 months. So then I wanted to talk a little bit about how you decide if you forward contract, if you hedge, if you use options, how you do that. So in our operation, we get all of our bean meal from Cargill, usually in Cedar Rapids, and I'll cash contract that because it's just simple and easy for us to do that. Forward contracts, I work with Tyson. I'll go up to 3/4 of my production on a forward contract, but I want to have some variability in there in case the hog flow doesn't quite match what I got contracted. And if I want to go more than 3/4, I will do that in the futures market with hedges. And another reason I'll use contracts, and Tyson I think takes 25 cents per 100 to do a contract, so it's a small fee, but then I don't have margin calls. And when you're marketing, margin calls are another emotional thing. People hate margin calls. You can't sell enough hogs when the market's going up to pay those margin calls. And as much as I hate them, my wife hates them 10 times worse. Yeah, so that's one of the reasons to use forward contracts instead of just hedges. So and the corn, we raise about 1/4 of our corn, and 3/4 of it we buy from a grain farmer. And we have different motivations. I want to buy it when it's cheap, and the grain farmer wants to sell it when it's high. So the 3/4 that we buy, I'll do that in the futures market. And then options, I don't use a lot of options. I need to learn more about them, and that's one of my goals is to learn more about how to use options. A good example of that is I had most of February hogs contracted, hedged, pretty much all of them. And then when did it bottom out? Last November. If I could have done an option, I could have kept a lot of that profit, but I didn't. And by the time I'm selling those hogs now, a lot of that went away. So one way to capture some gain in the market. I had to throw this in there. I bought a new truck for my truck driver, and he's pretty proud of it. But by the time you get to this point when the pigs are loaded on the truck and going to the packer, hopefully you've made good decisions and everybody's happy. That's my son and granddaughter. So that's my part of the talk. Now I would like to take questions. You're welcome to ask questions of any one of us, and we'll just pass the mic around. There's got to be questions. Who wants to start? Go ahead.
Question for Ron. You had a chart on profit for different operations. Was that all independent operations, or was there packer profits figured in there?
No, those are all independents.
What other questions?
I have a question for Ron, too. I don't want to put you on the spot here, but I was just looking for your opinion or thought process on it's fascinating to me when we see interest rates trading on 59-year lows for an extended period of time. In your opinion, why hasn't that had more of an impact just on U.S. growth? I mean, why haven't do you have any thoughts on why we haven't seen that stimulate things a little bit more than? I mean, that was the Fed's intention, correct?
Mm-hmm. Yeah. Yep. It was the intention, and I'm not the economist in our group. Okay, so I there's a whole bunch of reasons for that. I honestly think at the core it was a lot of fundamental fear. I mean, that's really, and then that drives all the decisions, right? And so, beyond that, I I can't comment a lot other than, we were talking earlier about the market and trying to beat the market. And the market is a beast in and of itself, and it's always going to take care of itself, right? And so I think, I'm a big believer in cycles and combine all that together. And I just, I'm not smarter to answer that question any more than that, so.
Yeah, I would just think that, there's some, those are all really good points. And I just, again, from just a bit of a macro perspective is, there was a lot of tough lessons learned in 2007, 2008, 2009, right? And a lot of those were good lessons, right? Especially when you consider it from a the real estate, fiasco, housing crisis, and all those sorts of things. So I think investors at a Fortune 500 level, investors at mid cap level, as well as individual consumers, are more conservative today than what they were prior to that, and it's probably going to take longer or more stimulus to sort of get things going again. And I think it's important to again just sort of think through all that a little bit, because I was just trying to communicate in my presentation. I think we're starting to see some of that now, right? You're starting to see a little bit more vibrancy in terms of interest, in terms of investment outside of agriculture and in agriculture, and certainly starting to see some signs of inflation, particularly wage inflation. Oftentimes, in any of the things that we're talking about, one of our biggest challenges, right, is finding help, not just in our production systems, but also in the packing community, and also hear about that outside of our industry. And so, that element of wage inflation is very good for meat demand, right? And so again, would just make the observation that I think, it's the Fed policy is starting to work, and we're starting to see a little bit more vibrancy, and it should be good for demand.
Thank you. Do you have a question back there?
When we talk about expansion, are you seeing any specific guidelines and demographics as far as producer size, producer age, region of the country, or is it pretty broad?
You want me to? I can start, and then we'll let you guys chime in. So, yeah, there's no doubt that expansion is underway, and it's underway in a big way. Again, not that we have any kind of magical crystal ball, but I believe that the USDA report in December, I'm going to start there, finally captured what's been going on in our industry for the last couple years. We've seen this expansion happening already for the last couple years, and there's no doubt that there's more to come. There's a lot of it that's underway, lots of plans here for 2017. And then I would also say that as far as geographically where you're seeing that happen, there's no doubt that the Midwest is the hot spot. Upper Plains, Missouri is a hot spot. South Dakota is a hot spot. Not too many sow farms that are going in Iowa necessarily, but certainly lots of finishing barns that are going on. And then as the trend has been for the last 15 years, we want to get the sows a little bit more on the fringe, and then bring those pigs to where the feedstuffs are, the packers are. And so those are a bit of the demographics that we're seeing today. My best guess, Hunter, I probably maybe shouldn't commit to this number, but I'm going to say that, when you kind of track, when you're in the industry and you know what some of the plans are, 100 to 140,000 sows that are being planned for 2017 wouldn't surprise me. And so that's kind of what we have going on right now. Yeah. Any part of that question and I didn't answer? You said something about demographics to me.
I was just thinking demographics as far as what farm size you're seeing.
Yep.
Or if it's age of producer.
You bet.
There's usually one or two demographics that really lead the chart.
Absolutely. No, great. Yeah, that was, I'm glad you clarified that. There's no doubt that standard industry size today is 5,000 sows. It seems to be the one. I mean, we still see 2,500s, and we see, 6s and 7s, and there's even a couple 10,000s that are happening. 5,000 is the norm, is the industry standard today. I haven't done the math on it, but my guess is that 80% plus of the sow farms that are going in are 5s today. As far as the age and demographic of the producer themselves, it's kind of interesting. When we talk about that, the really cool thing about what's happened in the last 6-8 years is that we've been able to bring back a lot more of the next generation that we weren't able to for a while, right? And so that's really neat that we see we're starting to see more of the next generations coming back to the farm or have come back over the last 5 to 8 years. And, so those farms are saying, okay, if I've been at 2,500 for a while, or if I'm marketing 50,000, now I know going forward, support 2 families or whatever it is, that we're going to have to go to 5 or whatever it is. Finishing barns, same thing. It really helps to bring that next generation back to the farm.
Yeah, great job, Ron. The only thing that I would add to that is that just a little bit on specifics there. So the folks that have been able to expand here, in a lot of cases, are reverse integrated systems, right? So there's a fundamental difference from 2008 through 2012. If you had to feed corn that you raised that was below market value versus having to buy corn at market value, right? So there is an equity opportunity there that puts some folks in a bit different position. So the lesson there, right? The reverse integration strategy was effective during that time frame. And then Al referred to you made the observation that 2014 was the most profitable year. Made more money in 2014 than you did the 10 years prior. Get it, right? That was a tremendous opportunity. And then Ron showed you earlier the spread between the profitable producers since then and producers that have lost money. So if you're in the top third of that range, if you will, you've been able to maintain that 2014 equity base that you've created during this cycle, right? And so that has nothing to do with the demographics, right, and age of the producer and all of that. But it has, I think, an awful lot to do with the reason why you're seeing the folks expanding that are.
I just want to make a couple comments. One is there's a little bit of a disconnect between the people building finisher barns and whether the profitability right now. My builder, I just talked to him last week. He's got 6 people, I think he said, lined up to build wean to finish barns, and they're just looking for a producer that'll put pigs in them. So a little bit disconnect there. Keep in mind that expansion takes 18 months to a year anymore, so once the ball gets rolling, it takes a while to slow that train down too. Same thing with profitability. If you get into a really profitable stretch and people start expanding, those extra hogs don't hit the market for a year and a half. So just kind of keep that in mind. And then also with the new packing plants with Triumph Seaboard and Prestige, they plan on buying about half of their pigs from independent producers. But I think all of us know that they want to fill a lot of that kill with their own pigs eventually. So if you ask me who's going to be expanding in Iowa, that's probably a good guess that they will be.
I would add just a couple other things when you talk about contract finishing barns, Al. You know what? The other trend that we've seen the last 5 years is that more and more people who own the pigs, so I'm going to call them integrators for the sake of this discussion. But again, that doesn't mean that it's all packer owners. It means that there's anybody in the top 50 or anybody basically that it wants contract finishing barns. What we've seen is a real trend away from. Let me back up. I'm sorry. Obviously, we know that Iowa's been a hotbed for contract finishing. Okay, but what's happened with all the ethanol plants that have come into Iowa is those dynamics have changed a little bit as far as the competitiveness of just the corn advantage. And so what's happened is that a lot of people who own the pigs are starting to strategically place barns outside of real heavily populated areas because what they're finding is that the corn advantage in that area or in those areas is no longer beneficial compared to the death disadvantage or the health disadvantage. And so, therefore, we're seeing a lot of people who are the contractors that are saying, hey, I want to more strategically place mine in areas that have less pig populations. So that's another thing that we're seeing as well. I think there was a couple other questions.
I'm wondering, given the dynamics right now, we're seeing expansion, but still lower commodity prices. You're from a lending institution. How long are we still seeing lenders willing to go out on the limb, if you will, to help out on this expansion, and how long will that continue?
Sure. Yeah, great question. So what happens is that in our lending institution, what will happen is that we have actually increased our standards a bit, knowing that what the trends of the market are. And so what that means is maybe before, if we would have done new facilities and wanted a post-close, say a post-close owner equity of 45%, today we might look at that and say, it needs to be closer to 50 or 55%. Okay, so we're raising our standards a bit, but there's still, again, as we talked about those thirds, if you will, there's a lot of people out there that can still do that. And that's where they still say that we can get our best return on capital. So yeah, the capital's still available. How long will it continue to go? Don't know if I can answer that question. I think we're going to have some major headwinds. The old saying, rising tide lifts all boats. I think that we've lifted a lot of boats here over the last 6 to 7 years in the farm economy in general. But the rest of that saying is that it's not until the tide goes out that you find out who's swimming naked. And so I think what we're going to find out here between now and the next 2 to 3 years, who's swimming naked. So.
If I may just follow up, and maybe this is more for you, Al. You kind of talked about the importance and the significance of the export market. You now have a new administrator, or new administration rather. Right away signed off and did away with TPP. I guess my question is, as you as a pork producer, you're heavily dependent upon trade and the value of what is it, about 1 of every 4 hogs in Iowa is exported. If we lose that for whatever reason or anything, what's your contingency? What else can we do? What else is going to happen? I guess.
I'm scared to death of that, honestly. Exports, if we lose exports, the big ones are obviously Mexico, Japan, China, South Korea. This country can't consume 25% more pork, so we have to export it. So trade agreements are huge for us. We're pushing the TPP. That would have really helped us get into some more markets. Every free trade agreement that we've had, you can see a chart that 5-10 years after, and demand just grows, because a lot of these countries have a 40% tariff on our products going in. Even China. I was in China this past fall. They have a 12% tariff on pork going in, and a lot of people don't know that. They think free trade means free trade, and most of the trade is not free. There's tariffs put on our products to protect their economy, their producers. And so there is a point there that, yeah, we let a lot of products into this country with no tariffs, but we allow other countries to put tariffs on our products. So that's huge. But the other thing with exports is this foreign animal disease. We got a glimpse of that in 2009 with H1N1. But if we get foot and mouth disease here, and we have all these countries say we're not going to take imports from the United States, I don't know. I think it'll be a 1998 type event. So I'm scared of that.
And there are some groups that are working on contingency plans if that happens, or trying to figure out indemnification. Different various options that people are looking at right now. But for a while, it would be a lot of pork that we'd have to slug through actually. So
And from a risk perspective, I think you just need to factor that in. The probability of that occurrence is higher today than what it has been in the past, and you need to consider that as you're thinking about your mitigation strategies. But I would also say that the current administration, from what I understand, right, is a little bit different in terms of a philosophical approach of how we've looked at things. And it's my understanding, as an example, that the administration has been in contact with 3 of the major partners of TPP recently. And so it's, instead of this multilateral 40-country, 4,000-page agreement, it's bilateral and negotiating individuals with countries. And again, I'm not suggesting at all that none of this is without risk, because it certainly is. But I think at this point, you gotta kind of trust the system here for a little bit and see how it turns out.
There was another question back there. Yeah.
So Al shared with us that it's about $100 a contract to contract off with the Packer. I think there's something out there that everybody's expensive than that. What would you say the average cost would be? I know we wait for time of how long you hold that position or that short future, but what do you think the average cost would be with brokerage cost and interest rates per contract?
Yeah, so the question is once I was referring to earlier, we got to decide what we're going to do and then execute. Then the how are we going to do that? Are we going to forward contract directly with the Packer, or are we going to short futures to hedge that position? And so again, the reference 25 cents 100 or so in terms of a cost associated with not needing to make margin calls. From a short futures position perspective, initial margin requirement is $1,200 a contract or something like that. So there's a nominal fee associated with cost of money tied up in the initial position, so. Quick little answer to your question is, 12, 15 cents, somewhere in that neighborhood on a per pig basis, it's something less than 10 cents 100. And then, years like 2014, right, where you have more capital required as you make those margin calls, that obviously changes. But, in years like the last couple, when you have equity in your position, that works as a real-time credit for your operation. So, it's getting equity back on those short futures positions that weren't closed yet in the fourth quarter helped an awful lot with cash flow, Ron, right? So, anyway, so does that give you a broad enough brush there?
I think just relative terms, when you look at, I want to spend $100 or $200 and head to the Packer and then enjoy the unemotional times for margin calls, or on the average, would it cost, say, $80 a contract to supply the money and do it through just a short future?
Fair enough. And so and then would just add the additional flexibility associated with that. One of the other things that I tried to drill down a little bit earlier was talking about the opportunity for managing basis. We utilize in our associate, our firm at least, is utilizing a bit of a strategic lifting strategy within the delivery period to help manage that basis risk opportunity, and so just provides for a little bit more flexibility versus a firm forward contract with the Packer.
Okay, everyone, I think our time's about up. I think these guys will be here for a little bit yet if you just want to come up and ask some questions. But thank these guys for coming. Appreciate you guys showing up, too.